Markets around the world are hitting all-time highs, but should we be changing our tune as traders and investors as we find ourselves at the most traded level in recent weeks? Yes, there seems to be something going on underneath the hood that has some stocks weakening across the board. Meanwhile, some commodities that were really good are not looking so good anymore. But is the outlook incredibly positive for these as central bankers buy them? Well, welcome back everybody to the special weekend edition of The Daily Show. My name's Tom, and as always, we'll be going through the latest macro, leading indicators, and the data that you need to know. As we all know, semiconductors and Nvidia saved the week because if it wasn't for that, things would be going down. But in today's video, we've got some massive flow data that I think you'll need to be knowing about because basically Wall Street is starting to do something very, very sneaky. As always, subscribe and smash that bell icon if it's your first time here and you want to know more about where the biggest market participants are entering in next. So let's begin the storyline by just looking at the last 5 days. And of course, it's NASDAQ up thanks to Nvidia and AI, and Dow Jones down. So what's this telling us? Well, it's clear the breadth is starting to weaken. And when we look at our analysis of the RSP a little bit later on today's video, things are starting to get a little bit shaky out there for the markets. The worst we've seen actually since the sell-off or just before the sell-off in April. So why is that? Well, there are some good shining lights, I guess, semiconductors being number one, and of course, basically governments getting involved and pushing solar through with their new tariffs. Some new kind of flows going on there, but there are also some problems. Consumer discretionary starting to look really weak, home builders looking weak, energy looking weak, and of course regional banking starting to flow a little bit down as well. When we look at the last 5 days of trade, solar's the best, gold, regional banks the worst, something we'll discuss later on. And when we look at the Friday action, it was all green, all good for things like solar again, getting another nice rally and a huge breakout on the close. So let's look through the bull and the bear case scenarios moving forward, and more importantly, talk about what kinds of percentages you could be looking at both ways. Because I think it's really important whenever you're talking about bear positions, is it really the big one, or is it more of just a little bit of a buy the dip style scenario? And this is always something we like to discuss. Well, here's a chart from Macro Charts over on X, and you can see here that we've started to enter into the fully overbought position. So this basically means you need to have your, cautionary headlights on. And as we know, we already start to see weakness in breadth. We start to see huge sellers, which we'll go through in a moment, and some dark pool activity, which we'll also go through, happening in the S&P 500. So there's some things of certainly warning signs starting to come through. Meanwhile, for the bull case, of course, central bankers around the world are very big to tell us that financial conditions are so tight and so hard to get into. But of course, we can see here that's not the truth. Loosening continuing on through the US and through the world. And that's leading into, of course, people speculating. And more importantly, people starting to feel a little rich because if you're buying AI stocks and you've been holding Nvidia for the last 12 months, then you're feeling pretty good about the world because everything's fantastic. But that money is flowing into information tech, S&P 500, technology in general, and not necessarily the world markets just yet, although that is starting to come through as we've seen in recent months. So where does this bring us to? Well, we need to talk about sentiment. What's going on in sentiment? Where are all of us thinking the markets are going to next? Well, people started to pick sides last week, the first time in a while. Everyone's been fence sitting for a little period, and then all of a sudden we saw that neutrality drop down. Some people picked the bear side, more people picked the bull side, 47% bulls. And although that's not a sign to instantly sell the market, it certainly is a point to start to say, well, if I see flows going against that and they are, fully fledged flows that make sense, then we might be in for a little bit more of a pullback than I might thought. What about this chart here from Grant Hawkridge? Well, it's a great one because it shows you everyday performance since the 1950s to 2023. And generally after the long weekend, Memorial Day weekend, we actually do see a bullish tinge to the markets. Now, this is just a stat in itself, but let's just say if we take the call resistance, which we'll look at later on in today's video, and we break past that level, what's it going to do? It's probably going to mean flows are going to come in, and we've got a nice squeeze on our hands in these markets. So the big bear case is breadth. There's no doubt that everyone's starting to see this one. Percentage of stocks above the 50-day moving average moved under 50%. And luckily for us, Jason Gopfert actually went through and did some stats on this, and he found some interesting results from it. Now, the first thing is if you were going to see weakness, it was going to happen in the first 1 to 2 weeks. After that point, it was generally quite bullish. And in fact, across most of the stats, we ended up seeing a percentage positive from that period in time, 73% 1 year later and 70% 2 months later. So in general, whatever dip would happen due to this type of read was usually short-lived, and then it rallied up. And that makes a lot of sense when it comes to where we look at the markets a little bit later on. Another one that we've been talking about is sentiment indicators, Goldman Sachs one in particular. This helped us to gain a little bit of advantage to see that April sell-off starting to occur. And that's because we were really stretched back then. We saw, of course, that stretch go away. And then since that point, we've V-shaped very quickly back into the stretch zone. And what Goldman Sachs indicator is basically showing you here, one shared from Mike Siccardi, is that we are starting to get into that little bit highly valued kind of area once again. And S&P 500 forward returns, although they're not near the peaks they were last time, are quite high. So basically, we're not near the absolute peaks. Do I expect us to get here? Yes, I do. Do I think that we have lots of pullbacks and all sorts of things in between then? Yeah, I mean, that's what usually happens. You get this type of thing. But this earnings season has clearly allowed Wall Street to go and up their valuations in particular in the future. And as I always say, the thing that you want to be really looking at if you're expecting a bigger sell-off is things like the bonds market getting really freaked out. And that's just not happening. Yield premium junk bonds versus treasuries, how are they going for us? Well, they keep going down, which basically means that bonds traders are not considering the risks of junk status positions. And I think this is like a big undercurrent in the markets. Everyone is starting to get euphoric. Everybody is feeling kind of pretty good about the world, even though we're in a really scary inflationary time in some ways. And that's leading into central bankers doing something very, very interesting indeed. And this is probably one of the biggest stories of the next 3 to 4 years, which is going to be what's going on in the metals market and what's going on in the gold market. Now, recently we saw a sell-off across board. And as I mentioned over on X, the big thing for us all to recognize, just like in stocks, is that the trend is really, really strong. So a sell-off could be seen as a buying opportunity. And this chart here really dictates, I think, one of the most important trends that we've been seeing over the last kind of 3-4 years, which is that foreign central banks are basically dumping US treasuries and buying gold big time. And this is because we're in a currency war. So basically what we're seeing here is we're seeing the rise of BRICS. Notice when they started doing this, just after BRICS really established itself back in 2010 to 2015, that big new establishment. And we're seeing a huge push towards getting rid of the US treasuries and getting into gold. Now, as central bankers purchase, they will then go to possibly float new currencies and say, look, these currencies are backed with gold, something that used to be historically done. And of course, since the 1970s, it hasn't been. You can see here central banks not holding gold, now starting to do it again. So is this good for things like Bitcoin, things like gold and silver in general? I would say yes. And what it shows us is that a lot of us have the wrong asset allocations. And what I mean by that is that retail traders, many of us, don't necessarily hold as much as we used to in these alternative assets, arguably the oldest currency of all time. In fact, gold allocation for investment advisors in 2023, and I can tell you it's the same in 2024, is between 0 and 1% for most people, and a few people hold between 1 and 5%, almost no one holding over 10% in gold. Now, this is a big change from where we were in the 2000s. People held a lot more gold back then. And that's because it had a lost decade. It had a terrible time for investment. So is it time to start thinking about this a little bit differently? Well, I'll let you put in the comments down below. What do you guys think would happen, let's say, if gold hit $3,000 an ounce? Do you think that some of these advisors would start to say, maybe we do need to hold a little bit more of that? Or more importantly, would the clients be actually asking for more allocation? Well, I think that could be the kind of point that we're at right now. And as you know, I'm pretty bullish on this type of stuff because when we tend to start these commodity price booms, after, of course, going into a bear cyclical market here, we do tend to run for a little bit of time. 2021, 22, 2017, 18. Notice what they are. They're 2-year periods. Now, we only just started to tick into this. So are we going to go into a 2-year period of strength for these commodity prices? Well, it does look like that could be the case. And in particular, I think metals will be spearheading it. And that's because we've got the resurgence of BRICS versus SWIFT, this thing that we're starting to see is the undercurrent of geopolitical situation. Emerging markets are also showing us a very similar trend. Usually emerging markets emerge when you're in some kind of inflation storyline and something to do with metals and commodities. And that's because there are a lot of metals and commodities in emerging markets. So you can see here when you exclude China, which is this blue chart over here, it's actually making a new high. So a big aspect here is breakouts across emerging markets and flows that are starting to lead on to that point. So again, we look at the US market and we say, okay, well, we know that things like AI are driving this market. We know that solar is starting to improve, and we know that we should be looking at a broad market improvement. Now, are we seeing a sign of a crash? Well, in general, I would say no, because most cyclical bull markets tend to last a bit more time. This is the April read. Of course, we find ourselves here in May, and really the median duration for a bull market is between 31 and 33 months. So there's expectation for longer. And if we start pushing into, let's say, the 40 plus months, well, that's when you can start to question everything, because that becomes a very important time. So, of course, we expect maybe a little bit of a pullback. The most close narrative, that is the stagflationary narrative, this is where basically the market is possibly going into a double dip recession. That would be this one here, 1966 to 2022. And even in this case, we still had more time to run, with the dips being relatively shallow until we went into a double recession. Now, I'm not thinking it's this one. I think it's more like a 1994 or more like a traditional presidential election year. But yeah, it's an interesting narrative anyway. As you can see here, we have a 2012 kind of market style setup where we've gone to a new high. We're still kind of chopping around, and generally June, July, August are bullish, with weakness that comes through August and September, October, that kind of period leading into the US election. So all of this stuff is very interesting, but why do we think that there could still be a bear here for a couple of days? Well, I posted this chart over on X, so definitely go follow us over there if you're interested. But let's have a look at the overall flows. So last week on Wednesday, we discussed the idea that we had 6 unusual days of negative net delta. Now, while the market was looking bullish and sideways and all up, it was actually all negative. Then we rallied, and of course we sold with a decent amount of sell-off across the board. In particular, the broad market sold off. Then, of course, it rallied throughout the Friday, and everyone went, well, you know what, the bulls are too strong. But you have to expect this to be always the way it is. So you can see here that the advanced decline line, that is, more stocks were dropping. Some stocks started to improve on Friday, no doubt, but we came back to the most traded zone. And in fact, this was exactly where you would expect it to come back to. If you watch our video on the previous session where we talked about, is this a miniature bull trap, we actually expected the market to come back to this point, 52.50, 52.60, to hold up the market in terms of puts, and that this will be where the decision is made. Now, at the time of this recording, my kind of scenario is maybe we rally a little bit more, drop, and if that type of thing occurs, I think we're probably going to push through 52.50, 52.60 and make it down to 5200. But if the bulls do end up winning out, they push past this level of supply, and then, of course, they go through the call resistance, then the squeeze is probably going to continue. And I think as a swing trader or multi-month trader, there's not much to be fearful of. I mean, at this point, this is kind of the scenario of where it might go. But day trade is certainly a very, very interesting point for markets. So let's have a look now at why that could be. We'll take a look at this. This is where the unusual activity is starting to appear. So as of Friday, a massive trade came in, and of course the markets rallied back up. Now they rallied into this line area. Now this line area is where some of the biggest trades have gone through over recent sessions. And you'll notice over here on the left-hand side, there was a big dark pool transaction that happened. The market rallied, the market dumped, and then conveniently it closes right on that print day. So right into that supply, right on that zone. So you can clearly see that, yes, something is happening underneath the hood. And at least with the evidence that we have so far, it would suggest that there's a real possibility that it's a seller. Now, it could be accumulators because, of course, buy here, buy there. They're just basically buying the sideways market for now. But the net delta does kind of show us that maybe it is sellers. So let's have a look at the options and see whether that marries up with those. First up, we have negative or positive gamma. And we're kind of stuck between really on the cusp of both. 5300-ish zone kind of going between negative and positive gamma. Notice the 5260 on Tuesday trade and the 5275 on the Wednesday trade. Now, this is where the big puts are. Lots of puts. Everyone went negative last week. If the market does move underneath those points, then of course that creates a cascade effect, and the next logical zone would be 5200. So that would be a negative gamma situation. However, if we manage to get through 5340, you can kind of see here a lot of calls stuck in this range. So they're going to need to be hedged, and that could push us towards the 5400 narrative, which is the June sell-off. So basically, or the June OPEX. So basically, this is where the markets are kind of projecting out. Trapped within an area, price action and flow will be the most interesting point. Let's have a look whether the CTAs agree with us, the commodity trade advisors. Well, I would say they're neutral on the NASDAQ and they're neutral on the S&P. So no real agreements there, but certainly something that's very, very interesting to look at. And if we do get any updates from this point, we'll of course be checking in and having a look at it. In the broader market, just a couple of others I thought I'd put in here. Brent, a little bit of an increase. Price obviously hovering around very important zone. We'll look at that later. That's US oil and Brent in general. And then gold dropping like a cliff. So obviously CTAs selling gold fairly heavily. And that works in with the narrative because gold needs to have a reset. And I'd like to see CTAs get it back down to this level and then, of course, move back into the gold side. So yeah, gold definitely probably a little extended still even at these prices. Let's move over to a couple of other options here with Tesla. Tesla first up, 175 where the puts are. So clearly some big support there. Huge support for the OPEX. And you can see a lot of people betting on the negative side for Tesla moving forward. And if we manage to get through 180, then I think 190 and 200 become exposed because that goes from the neutral kind of positive negative gamma situation we're in at the moment. So the neutrality level here. And we start to go positive gamma, which again creates that squeezing event, as we've seen quite a few times before. When you look at NVIDIA, 1100 is the clear target. You can see whether it's the OPEX or this week or next week. All of them are pointing towards calls everywhere. The flows were massive. And while I don't really like to join in on these flows unless you've got proper risk management, hopefully you were in earlier if you were, maybe a month ago, then NVIDIA, is really gunning for that 1100. But as we'll see on the charts, it is starting to show signs of a little bit of exhaustion. So before we go into everything else with the main key charts, I want to just quickly talk about housing because it is important to the stock market. And you'll notice here that housing inventory estimates continue to be quite low. They're upticking a little bit, but continue to be quite low. So fairly robust market. But on the other side that I found interesting, especially for the US, was that people think they want to change and move to new locations. Now, this is interesting because interest rates are so high right now in comparison, and a lot of people will be breaking lower interest rate mortgages to actually get into a house at higher interest rates. So I think this is a very interesting chart indeed and something we should be paying attention to. When we take a look at the China index, you can see here as well some interesting stuff from Goldman Sachs, and that's showing us that in most of their case scenarios, they are bullish for the year. Their bear case is negative 19. But I think that it's pretty clear that there's been some nice flows into China in recent times. And we've, of course, been following them on the channel and we'll continue to do so. There's a pullback right now, and I expect that to kind of make it a little bit more down. Then we'll look at it in the next video. Salesforce this week, Costco this week, Dell this week, few decent brands and decent names. As general, we always say make sure you're aware of the options moves. Chewy here, for example, plus minus 13. Salesforce plus minus 7 to 8%. The options market is showing that every one of these stocks has wild earnings. And I can't remember a time when we've seen such huge flows moving up and down and all around, with actually the S&P 500 being relatively stable while the huge flows are going on. Let's begin the charts. The VIX here to start off with, underneath 12. That always means that it's more of a complacent market. And of course, we're seeing that complacency in our bond indicator as well. No fear, none of the same things that we saw in March into April, where we thought the market would pull back a bit more, which it did. So again, not really too much fear on the horizon. From Dow Jones Transportation to home builders to anything else, they're all weak. I would say they're all weak neutral. And the same thing here with the American consumer, which is weak neutral. But what that's trying to tell us is that we are in late cycle investing. So basically, this means that whatever's going on with this market, it's starting to get more defensive. And even though you might not think that because AI is going ballistic, that's because that's the hotness. So the market is not as healthy as you look at underneath. It's probably the sickest we've seen it now since that sell-off in March, April. But even still, things like the MOVE index here, the bonds market, it's not freaking out. There's no freak out. Therefore, the stocks are still just moving with the ebbs and flows. And I think the S&P 500 will need to trigger. And again, we don't expect a huge sell-off from that point due to the fact that there's nothing really freaking out just yet. But that could change. What about copper? Well, copper fell off a cliff. Yeah, it lost about 5-6%. It's come back to the daily 20 moving average, and there's no turn on the small time frame. So again, looks weak. I'm looking for a sign of turnaround. This could be an area which we've labeled as a watch reaction here, but at the same time, we don't have a price update. So we'll look at that very, very soon. Same with US dollar. Now, US dollar made it into that 105, 105.20 zone. This is where we expect weakness to come in for the dollar. It has so far, but it hasn't changed trend towards the downside on smaller time frames. So again, we'll update when that occurs, but the dollar was showing those kind of signs. Gold, another one, most traded level for gold. Certainly a key zone for someone that's wanting to start to begin or has a position, say, well, I like this level. But from a trade perspective, no signs of turnaround just yet. So really just holding that level, another bull zone here. And I could even see it down at 21.75 and still being bullish. So for me, these are the three main zones that you're looking at for gold bugs and gold bulls to pick it back up. Meanwhile, silver's holding better than gold, which we expect. If you go back about 3-4 videos, we talked about silver versus gold ratio. Silver's playing catch up. It's had some incredible movement through. And of course, like gold, I think it's going to go to 3,000 plus an ounce. I think silver's going to go like $50. So it's going to be some big moves over the next 12 to 18 months. Now let's move over to US oil, because of course, US oil is very weird trade because it came down to our great bull zone, found buyers, dropped down. Obviously here we basically said, okay, well, we don't like it anymore. We think it's going to make a new low. It doesn't look as good. It did make a new low. It rallied up, giving an excellent scalp short in here. So excellent scalp short. And at the moment, it's trying to resurface. So I'd see this as equilibrium. The market's not sure what it wants to do. It could go rally. And if it does, and of course CTAs do pick this back up, then that was a 1, 2, 3 trap, Wyckoff bottom. Looks really, really good. At this point, though, I would say it's more weak than strong because, of course, it broke to the low. So up and around here is where the bears sit. Daily 20 moving average, as we've talked about several times, acting as an amazing resistance support line. And 72 a barrel would be the excellent next bull zone. Tesla held its area, 173, fantastic hold for it. Obviously moved up to 180, which is the key zone for Tesla. So definitely a good level for it. And if it does break out past 180, I could see it at 190, 195, 200. But it needs to hold this zone. There's so many puts sitting around here. So it has to hold up. And it's doing so far. What about solar? Well, it looks like solar had a great weekly close. Fantastic weekly close up here. Daily looking good as well. Big flows into it. We've discussed this for quite some time as a potential massive build of a position from Wall Street. And it did also have that huge trap level down here. So I'm a bit of a fan. I do think that it's improving. And for the first time in ages, solar looks good. It's very risky though. It's going to move 10, 15% all the time. So just remember, it's the beginning of potentially a catalyst. But if you load it up and look at the charts, you'll notice that it did lose 80 to 90% of its overall value. And at the moment, solar is filled with just a few stocks making those bull moves. What about Robinhood? Well, Robinhood improved. We obviously saw a pretty negative reaction to, I think, a good earnings. And then the market rallied up, showing me that, yeah, it probably was a trap. Then it dropped and it rallied, created an engulf off Friday. I think that's a kind of good thing for Hood. So Hood holding itself. What do you think? I think it could go to like 36, 33 a stock over the next 3 to 6 months. Let's move over to NVIDIA. This one here does show us a red stop sign. So, of course, to me, it's starting to find maybe that exhaustion in it, but it's running that beautiful earnings. I do have it as one of the pillars, NVIDIA, Microsoft, Google. I think they're the three best stocks in the market in terms of the mega caps. And at this stage, it looks like it wants to go to 1100. So it's running that options kind of thing, but I would still be cautious of it as a trader. An investor, who cares? It looks really good. Stock split, we're already showing positive correlation with that and everything else. Aussie 200 holding itself up. Maybe it's making a head and shoulders. Who knows? Here's a left, here's a head. Will this be a right? And then it breaks down. Obviously, S&P 500 could be the dictator of that. And funnily enough, that head would actually price in around 7558. This is the major support down here, and it's in the middle of limbo land. I am bullish on the Aussie market, though, moving forward. RSP, equal weight, inside candle. Overall, was weak last week. Obviously, Thursday was a horrible session for it, and it didn't make a new high as the S&P 500 was making a new high. So it shows you that there are a few stocks that are way better performing than the overall weight of the market. Is that a reason to sell by itself? No. And again, as we see here, the S&P is the only thing giving us the evidence. The US 2K hit its first bull level. If it sells off, I expect it to go between 1970 and 2000, being the secondary bull level. And the NASDAQ has been very strong, but it did show me, signs again of exhaustion. So I'm not surprised to see it find this volatility. I expect it to be sideways to down a little bit. Overall, I think the bulls are in control, guys. So just remember, it's probably going to be short-lived. 3-4% is usually what you expect in these types of pullbacks if they do occur. So yeah, interesting one here on the NASDAQ, and it's right back on those highs. But I do think that if 72 is broken through, it's going to be very strong for Bitcoin. Nice consolidation now since March and Feb. So really, we're looking at consolidation. Usually this is the period that alts go. We'll do a special on that soon. And as you can see here, 66 held up really nice. That red box hits into it, bang, found a buyer. So to me, yeah, the crypto world's kind of like gold at the moment. It does look relatively strong. And of course, as long as people are seeing AI and this kind of euphoria around, you've got to think that the crypto market is going to improve. And of course, I think that Bitcoin will make it over 100K by the end of the cycle. Now, what else is happening? CPI for the Australians out there, that'll be a very interesting result, especially for housing. And then, of course, core PCE price index on Friday, May 31st, 8:30 a.m. And that's going to be the one that the Fed's looking at. As always, guys, remember to subscribe, smash that like button and alert button if you do enjoy the show. And follow us on some of our other socials as well, including our X, because, of course, we do post some excellent charts over there. And hopefully you enjoy them. Also, if you ever want to know more about how we create pinpoint entries and find them inside of commodities, cryptos, stocks, and everything else, then check out our 7-day flash sale. So thanks so much. Have a great weekend, and we'll see you in the next one. Bye for now.